Housing prices are at an all-time high. Even during the pandemic, housing prices continue to increase. Is this sustainable long term, or are we looking at another housing crash like we saw in 2008? In this video, we're going to look at what is driving the housing market. Is it the same thing as the 2008 housing bubble, and what the future of housing prices might look like? Before we begin, don't forget to like and subscribe to support the channel. From 2004 to 2007, real estate prices were constantly increasing. This growth was pushed by really cheap loans and minimal requirements for these loans. So pretty much anybody could go out and buy a house, even if you did not necessarily have the income to afford one. These loans were known as ninja loans, or no income, no job, or assets. Mortgage brokers were pushing these loans through because they got a commission on every loan they made. This made it so that they really didn't do any due diligence to make sure these people were actually qualified financially for the loan. This made people who normally wouldn't buy real estate jump into the real estate market. Real estate was also seen as one of the safest investments you could make because it was always appreciating in value. Worst comes to worst, you refinance your house and pull out all the appreciation so you could actually afford the house. This all works out if real estate prices constantly go up. But when they don't, you start to have major issues. To pile onto these issues was a lot of these loans were variable rates. So once mortgage rates started to increase, people's loans got more expensive. Soon they couldn't afford the monthly mortgage payment and began defaulting on their loans and forced to sell. With these prices so high though, people weren't looking to buy homes. So what started to happen was a lot of houses went up for sale, but there were no demand for them. This made real estate prices drop, and they dropped so much that people were actually underwater, or they were selling their houses for less than what they paid for it. People then stopped making payments on their homes and mass foreclosures began. During this time, housing prices dropped an average of 34% nationally. Banks started to really feel the pain on all these foreclosures, and the government stepped in and bailed them out to prevent further economic damage. This worked, and from 2011 to 2019, real estate has made a comeback and now even surpassed all-time highs. Then the lockdowns happened, and this started to become uncertain of where things were going to go. In March, everything was basically shut down and the stock market dropped nearly 40%. In response to this, the government came out with the stimulus package, and the Fed dropped interest rates to zero, bringing mortgage rates down with it. This made money super easy to borrow and increased housing prices. In general, the lower the mortgage rate, the higher the actual price of the home will be. This makes it so people who have a set monthly budget can actually spend more on a house because it's cheaper to borrow money and their monthly mortgage payment will fall in line with their budget. However, with the lockdowns, people were hesitant to put their house up for sale as they didn't want strangers walking through their homes, and they might end up losing their jobs, so they kind of just stayed put. So inventory for homes were low, while people looking to buy were high, because they could get such cheap loans now. This made housing prices increase even more. When a new home went up for sale, there would oftentimes be multiple bidders, which increased the price further. So as stocks continued to fall, people ran to real estate to diversify their investment and be sheltered from swings of the stock market. People also looked at real estate as a bet against inflation. As the Fed continues to print more money in response to the lockdown, people think that inflation will start to rise. With the real estate, however, if you take out a loan, the loan actually becomes cheaper to pay off as inflation increases. This is because the value of your money today is actually worth less than the future because of inflation, but the loan amount is still a set dollar amount and doesn't go up based on inflation. So if your interest rate on your loan is lower than inflation, it actually is just paying for itself to keep the loan. This is why real estate is seen as a great investment to protect your money from inflation. All of these factors are causing home prices to skyrocket, and we are seeing prices start to get even more out of hand. With low rates and low inventory on houses, we will most likely still see an increase in home prices. Once things start to open back up and people start feeling more comfortable about putting their homes up for sale, we might soon see housing prices stable out or even begin to decrease a little. We are also seeing a mass migration out of cities as jobs are becoming more remote and many people aren't willing to pay high rents in the city if they no longer need to be there for work. As this begins to happen, we might start to see prices in major cities decrease. As more areas surrounding cities, those home prices might start to increase. Also, with many people permanently losing their jobs and the government programs and stimulus coming to an end, we might soon see a wave of foreclosures like we did in 2008. This can mean that the inventory of homes for sale will overwhelm the demand, and we might see a sharp decline in home prices. If this happens, it might be the best time to buy a home though, if you could afford one, that is. It is because interest rates are so low. If there is a decrease in home prices with low interest rates, it could be a win-win for the buyer. So what does this mean for the overall economy? At this moment, it seems like the government and the Federal Reserve are doing anything in their power to stimulate the economy as much as possible. But with unemployment benefits and renter protections coming to an end, and the Senate in a stalemate, it is uncertain what the next stimulus package will look like. No one really knows what is going to happen to the real estate market in the future, but we soon might start to see a little more volatility in home prices than most people are used to. And with that being said, as always, thanks for watching and like and subscribe to see more.